Welcome to Insights. I'm Eric. Thanks for stopping by today. We're going to talk about the Matrix and do a quick review here. We're going to talk about the stock market again. The stock market is an important leading risk on, risk off asset of which it's trying to set its direction, stuck in between some important lines in the sand that we've talked about extensively in the economy and a stock report and the special report which we created for this. I'm not going to go into too much detail. We've updated those recently. We've talked about the lines in the sand that are important that price has to get through in order to jump the creek and then and break the ice, which would be a jump or a continuation of the rally versus a turnover into a decline. You can go look at those specifically. I suggest that you do that. There are some important changes that took place recently. We've introduced a line in the sand that was in between an air pocket to the upside, of which I would have thought that the rally would have taken place quite easily prior to this until I saw that, or at least the computer showed that, and that hasn't gone away either. So take a look at those reports in particular. If you don't have the economy and stock report, the special report was introduced to just go over this specifically. It's a cheaper way to keep an eye on this, but I think the stock market's going to be an important part of the fall setup here, whether it be you want to call it the risk on or the failing of risk on and turn it into risk off. I don't think there's any conclusions that can be made until we really break out and get into definitive territory. I know people are starting to take bets one way or another, but that is not really the smartest play here. You can see some of the directional changes, the timing models. We see the sentiment and the VIX models are both in agreement since August into the bull phase. But that doesn't always mean that they're going to be taken off. These are early. They can fail. They tend to fail early rather than later, or in the middle of the inside their cycles. So we're going to watch these. This is only four weeks old. This is only 16 weeks old. These are bigger numbers than they look. You can see that they are relatively small. In terms of their cycles, the price and time cycles are minus well below zero in both of them. So they can still fail here. We've been keeping a close eye on the equity DI, which here is, you can see the composite equity DI is 50, 26, and 49. That's slightly down from last week, which means that perhaps the energy build into the bullish energy build is now over. And the real question is, as it starts to release, is it going to generate much of a stock market rally? That's where those lines in the sand that are above price are so important, and you should have those written down in particular. The other thing that continues to linger, and this is probably the primary reason why we're going to do this quick review this week, because it's just one week after another, is the decoupling that's taking place inside the correlation section of the matrix. This is the decoupling between the S&P 500 and the VIX and the term structure of the VIX. And it's not just a minor decoupling. You can see, and I'm going to focus on the weekly down here, these four W's and four right here, and they are the weekly correlations. They're decoupling in the exact opposite direction of the normal trending cycle. So if this market is going to go into a rally phase, say it jumps the creek, or it goes into a decline phase and breaks the ice, you want to see this take place as you have a trending market between the price and risk and inside the term structure of risk, which is in the futures contract. The fact that it's decoupling and doing so in such a wide margin, you can see here these numbers are almost 1 and -1 here. And a normal trending market is in the exact opposite direction. In this case, it's -1 and it's +1. And we are almost pinned to the exact opposite side of things, which tells you how far this market is out of gear. How do you use correlation shorter term? It's a warning. It's a warning that something's not right. Even though the equity build is still quite bullish and powerful, the primary trends are all still down. They want to flip up. The market wants to rally. We've got this bull phase, but we do have this decoupling, which warns us that everything that's taking place, everything that we're looking at through the store window, is kind of an illusion at the moment. I mean, this has to be clarified. This has to be clarified for either the bull or the bear case relatively soon. I fear that as the longer the decoupling lasts, and the more the primary trends in the stock indices remain in the bullish column in the phase, even though they're not extremely profitable at this point, the more likely this is going to break the ice. Now, that's just a guess or an assumption at this point. The way you use this and the way we use the matrix is to follow it by the numbers. We really identify what those lines in the sand are, and we wait to see if the decoupling breaks apart after it crosses those, either to the upside or to the downside. I don't want to like sit here and say, well, we follow this in particular. This decoupling is important, but it must be followed in terms of the reversals that are here. Specifically, the S&P 500 or whichever market you're interested, we talk about important reversals in the NASDAQ 100 report. We talk about them in the special report and the economic report, but they're really for the S&P 500. If you were able to figure them out yourself, go ahead. If not, check out those reports because I think those are going to be the important lines in the sand. I think once decoupling is resolved, we're going to find out whether it's to the bull side or to the bear side. And I think a lot of this stuff is going to get resolved. And not every composite equity build plays to an upside breakout. Sometimes there's a subtle delay. Sometimes it's a couple months before it bottoms. Perhaps the bottom's going to, that it's forecasting is going to take place in 2023. You must be careful with it, but in general, large bullish energy builds tend to be resolved to the upside. If you have any comments or questions, let us know. If not, thanks for watching today's review and keep an eye on the rest of the matrix throughout the week.